Welcome to the market updates. Okay, so we're looking at a market that just keeps climbing. And that brings up the big question, right? Is it too late to get in? Well, in this explainer, we're going to break down exactly that. The opportunities, the risks across stocks, metals, and crypto. We'll give you a clear roadmap based on what the analysis is telling us. I mean, it's the question on pretty much every investor's mind, isn't it? You see those charts. The S&P, the Nasdaq, just pushing new highs day after day. And that FOMO, that fear of missing out, it can be absolutely overwhelming. So let's just cut through all that noise. We're going to dig into the analysis and lay out some really clear, actionable strategies for what to do right now. All right, so first things first, where could the U.S. market actually go from here? Well, the answer really starts when you understand the psychology behind the price. And right now, what we're seeing is this fascinating tug of war. You've got two very different groups of investors pulling in opposite directions. Yeah, this is like a classic Wall Street standoff. On one side, you've got the institutional money, the hedge funds, the so-called smart money. And the data shows they are cautious. They're actually fearful of a downturn. But then on the other side, you've got the individual retail investors, and they are just full of enthusiasm, ready to buy up every single dip they see. And believe me, this division, this is the key to everything. And this is where it gets kind of paradoxical, right? You think, oh, the big funds are scared, that must be a bad sign. But actually, market history tells us the exact opposite can be true. See, a real market top, that usually happens when everyone is a bull, when everyone is super optimistic and already all in. So that fear we're seeing from the institutions, that's not a warning sign. It's potential rocket fuel. It's a huge wall of cash just sitting on the sidelines. And if they get forced to buy in, that could push this thing way higher. Okay, so with that whole wall of cash idea in mind, let's zoom in a bit. Let's look at the major U.S. indices. What are the charts actually telling us about the S&P 500 and the Nasdaq right now? So the S&P 500, it's literally knocking on the door of a super critical breakout point. If it can just push decisively past its old highs, that could be the trigger. That could be the moment that unleashes this massive wave of FOMO from all that sidelined money we were just talking about. And what's the number we're looking at? The analysis is pointing to a target of 7,300 for the S&P 500. And look, that's a conservative target. It's not a ceiling. It's just the next logical place this thing could go if the rally keeps up its momentum. So the bottom line is, the technicals are basically backing up what the sentiment is telling us. Both the S&P and the Nasdaq are in pretty clear uptrends. I mean, when you see something like the Nasdaq dip down to a key support level, like one of its moving averages, and then just bounce right back up, that's a huge sign of underlying strength. It's telling you that even at these high prices, buyers are still eager to step in. All right, but hey, it's not just stocks that are on the move. Let's pivot and talk about precious metals. Because for gold and silver, which have also had an incredible run, the strategy starts to look a little different. Okay, so the strategy here really boils down to one simple question. Do you already own it, or are you looking to buy? If you're already holding gold and silver, the guidance is pretty straightforward. Just hold on. But if you're a new buyer, the analysis is basically screaming, be patient. Don't chase these prices. For gold, that means you might want to wait for a dip, maybe down to that $3,250 to $3,300 range. And for silver, you're looking for a really clear, decisive break above 38 bucks an ounce. And what's the reward for being patient? Well, for gold, the analysis is targeting a potential 8% upside from where we are now. And, after the massive run it's already had, another 8% gain is a pretty solid, realistic return. It shows there could still be some gas left in the tank. And finally, let's tackle the market that probably creates more FOMO than any other, crypto. For assets like Bitcoin and Ethereum, a lot of people feel like the train hasn't just left the station. It's like halfway to the next city already. And look, the analysis doesn't sugarcoat this at all. It's pretty blunt, actually. If you're looking to buy something like Ethereum now, you just have to accept the reality that the easiest, biggest gains have probably already been made. By definition, you're a latecomer to this particular party. So if the easy money's gone, what do? Just give up? No. Buy and hope for the best? Absolutely not. The answer, according to the analysis, is you have to shift your focus. Stop chasing the gains, and start managing your risk. And that brings us to what is maybe the single most critical tool for anyone coming in late, the stop loss. Think of it as your preset exit plan. Before you even click buy, you decide on the exact price where you'll sell if things go south. It takes all the emotion out of the equation and basically acts as your financial safety net. It's essential. So here's how you put that risk-first strategy into action. For Bitcoin, which a lot of people see as a long-term hold, the advice is to buy in pieces, average in over time. But for the more volatile stuff like Ethereum and Ripple, the rule is absolute. You can think about buying, sure, but only if you have a hard stop loss set up from the very beginning. The analysis points to levels around $4,000 for Ethereum and about $3.10 for Ripple. And this part is just non-negotiable. It's pure risk management. And this really leads us to the single bluntest piece of advice in this entire explainer. The message is incredibly simple. In today's market, for these kinds of assets, using a stop loss isn't just a good idea. It's pretty much mandatory. The takeaway is powerful, and I'm quoting here. If you don't want to use a stop loss, then you shouldn't buy. Look at other things. Which really leaves us with this one final, crucial question to think about. In a market like this, a soaring market, we get so obsessed with the price we pay. But maybe, just maybe, the bigger risk isn't the entry price at all. Maybe the bigger risk is just jumping in without having any kind of a plan. Thanks for joining our channel. Your subscription and likes will be appreciated.